To me, it's more important to handle tax liabilities first, and then let's worry about taxable growth after. Or like to me, I'm looking at the liabilities on my balance sheet, i.e., my retirement. I want to know what can hurt me before I start wondering, well, does this grow tax free? Does it grow taxable? Like those things are minimal swings over the course of 20 or 30 years for most, obviously $1 million, $2 million portfolios, as opposed to you could lose almost half your IRA if you don't get ahead of this IRA tax thing. And they're like, what? You're like, yeah, did you know that? Well, here's how it works, right? You obviously have this IRA thing. It's probably your biggest financial asset. And most people don't realize you owe Uncle Sam a loan. And that loan is the taxes on that IRA. And the only question is when and how much is he going to charge? He's always going to get his money. And people are like, no, I'm going to die and it's going to go to my kids. Wrong answer. It's going to get taxed at their tax rates, which are usually much higher. And it's their income tax rates, not capital gains tax rates, income tax rates. So it's the bigger numbers. So when we think about this, you're retired. You're probably in your, a lot of people are in their early 60s and they're like, well, what should I do? Or maybe you're in your early 70s. I'm trying to think through how to handle my IRA. And all they've ever been told is, why would you pay taxes if you didn't have to? I mean, how long can you wait right now, Randy? Yeah. 73. So why would you pay taxes if you didn't have to? That's frustrating advice. I feel like putting off things that you need to do probably isn't very good life advice. Especially when you can plan ahead and really manage that tax liability almost completely effectively and predictably. So what we do for everyone, say, all right, here we know your income. Maybe you haven't turned Social Security on. Maybe you have. Maybe we delay Social Security so we keep your income a little lower while we try to get that money out of your IRA. And we use your IRA as opposed to your Social Security, get some gains, whatever. That's semantics. At the end of the day, regardless of whether or not you turn on Social Security, we're going to start taking money out of your IRA. And we're going to do it systematically to show you how we want to maximize your cheaper tax brackets. Oh. So can we get that? So when we're doing that, we can get that money out at 10 cents on the dollar or 15 cents on the dollar, which is really exciting, right? When you can get money out that cheap, Randy, when you get money out at 10 or 15 cents on the dollar, you're winning. And I know people are like, well, I don't want to pay taxes. Like, you have to. Like, this is just a question of how high are the tax rates on my IRA going to be? Because the second one of you, obviously a member of your family, a spouse passes, your rates effectively can double. So instead of paying 10%, you're going to be 20, 25%. Because why? You're taking the same amount out, but you're getting the single filing tax rates as opposed to the couple filing tax rates. Oh, we call that the widow's penalty. People run into that all the time and their financial advisor never warns them about it. So getting that money out systematically over time allows us to really hedge against that risk. And then even worse, when the surviving spouse passes, it goes to their kids and their kids pay at their kids' income tax rates and they don't get to stretch it anymore. Remember the old stretch? We used to hear the word stretch your IRA. Can't do that anymore. Laws change. You only get 10 years. And most kids don't wait the full 10 years. Why? Because they want to spend your money. And if they're taking it all out one lump sum, it's all getting added to their income. And that means they're going to higher income tax rates, pushing them up to 40%. So that $1 million IRA, $400,000 can go to Uncle Sam with no planning. Listen to your financial advisor waiting till 73. Or you can have a tax map that is a plan that helps you systematically get out. And of your $1 million IRA, maybe 100 or 150,000 goes to Uncle Sam. 100,000? 400,000. All it takes is proactive planning and someone to care enough to have the conversation with you every year. You know how hard it is to have conversations that say, you know how you beat Uncle Sam? Pay the tax. People are like, what? You know how hard it is to have people, we got to get people to pay taxes and before they have to? It's hard to get that conversation rolling, but once it gets rolling and they understand the savings, it's life-changing, right? Like we're saving $200,000 or $300,000 in that example. And you're just like, it's not, I mean, the math makes sense. And people don't think taxes are going to get smaller. Our debt's getting higher. Obviously, America's not really on a great track right now. We're getting further and further in debt. And the only way to pay off debt is to charge more money in taxes. So why not capitalize on these lower tax rates now, Randy? And that's what we're really pushing retirees to think about when they're obviously thinking about what are the most important things I can do in retirement to make a difference on my life savings, my life, is to get the tax map rolling. We do it at no cost. We'll build it for you and show you what yours looks like. And obviously, if you become a client, we actually, update it every year for you.